There's a huge pile of national wealth right on top of New York City's solid bedrock, 80 feet below the busy streets of Liberty in downtown Manhattan. There are about 500,000 gold bars in the vault of the Federal Reserve Bank of New York. That's more than 6,000 metric tons of gold. For many years, people thought this underground fortress was the safest and most secure place to keep money on Earth. This was where countries from all over the world, from strong European economies to up-and-coming market giants, happily and safely kept their national treasures. It was easy to see why people thought this way. The United States was the most powerful country in the world, the protector of the global money system and the defender of the law. Putting your country's gold in New York was like putting your savings in the safest, most reliable bank account you could find. But right now, the vault on Liberty Street is experiencing a slow, quiet version of a bank run around the world. The Great Repatriation is something that mainstream financial news doesn't cover with the seriousness it deserves. Central banks around the world are buying physical gold at the fastest rate ever recorded in history. Recently, they have been adding well over 1,000 tons every year. They're actively and sometimes secretly pulling their current reserves out of the US and UK. They're hiring big cargo planes, hiring private military security companies, and sending thousands of tons of gold back to their own borders. This isn't just a small change to the way things work. This is a huge, organized statement that people don't trust Western financial systems. This is a revolt in the central bank. We need to know why the gold was kept there in the first place to understand why this is happening. When World War II was over, Europe and Asia were in bad shape. The Bretton Woods Agreement made it clear that the US dollar was tied to gold and that the US controlled most of the world's official gold reserves. During the Cold War, West Germany and other European countries on purpose kept their newly earned trade surplus gold in New York, London, and Paris. They were scared that the Soviet Union would invade. The German government wanted their national wealth to be safely across an ocean if the Red Army came through the Fulda Gap. This money could be used to support a government in exile or pay for a huge reconstruction. In addition, keeping gold in New York or London made trade between countries very easy. There are 122 separate wire mesh compartments in the New York Fed Vault, each one set aside for a different sovereign country or international organization. If France needed to fix a trade imbalance with the UK, the Fed would just send workers in shoes with magnesium tips to move a pallet of gold bars. From the French compartment to the British compartment across the hallway, the metal stayed inside the building. It was the most efficient time. But the key to this efficiency was complete trust. It required complete trust that the host country, whether it was the United States or the United Kingdom, would never, under any circumstances, seize, freeze, or weaponize that gold as a way to put political pressure on the owner. In February 2022, the United States, the European Union, and their G7 partners froze about $300 billion in Russian central bank reserves in response to the invasion of Ukraine. This included blocking access to tens of billions of dollars in gold held in offshore accounts. This trust was permanently broken. The political landscape changed quickly. Washington saw this as a necessary nonviolent financial weapon to punish someone who was being aggressive. But for the rest of the world, especially the BRICS countries, the Global South and the non-aligned movement, it was a very scary wake-up call. The West had just shown that the sovereign reserves they kept in their own countries weren't really yours. They were assets with conditions. You could only control them if your foreign policy was in line with what Washington wanted. The news spread like wildfire through the world of central banking. You don't really have economic independence if your national savings are in a vault in New York. You have a huge golden prisoner. If the next U.S. government doesn't like your trade policies, your domestic rules, or your international partnerships, they can just not open the vault door. The safe haven suddenly looked just like a cage. The answer came right away and keeps getting faster. Look at what India has done. It has always been one of the most stable and reliable economic players on the world stage. The Reserve Bank of India, RBI, kept a lot of its gold in the Bank of England's vaults for many years. This was because India had to pledge gold to get an emergency IMF rescue package during the 1991 financial crisis. But in 2024, the RBI did a very secret operation that involved military-level security and several secret flights to bring more than 100 tons of gold from London back to Mumbai. By the end of 2025, the RBI had taken this localization strategy even further, moving more than 65% of its huge 880-ton reserve back to India. The Indian government didn't say anything bad about London or Washington, but the fact that the metal was physically moved said what they didn't say. We do untrust you to protect our wealth anymore. But this uprising isn't just happening in the BRICS countries or other developing markets. The panic has reached the inner circle of America's closest economic partners. Germany, which has the second largest gold reserve in the world, started a program to bring gold back home years ago. They got hundreds of tons back from Paris and New York. They did leave about 37% of their gold, which is more than 200 tons, in the New York Fed in early 2026. There was a huge argument in the German business and political world. Politicians, taxpayer groups, and top economists all started calling for the immediate withdrawal of the remaining gold. What did they say to the public? The U.S. government's unpredictability and the aggressive use of tariffs and economic pressure. They knew that in a time when trade deals are falling apart, having $1 trillion of German wealth sitting in Manhattan gives a rival economic power a lot of strategic power. The idea of a Western custodial guarantee has been shattered if Germany, a key member of NATO and a cornerstone of Europe, thinks its gold is not safe in American hands. This is happening over and over again in Eastern Europe. Poland has been on a historic gold-buying spree, buying hundreds of tons of gold and publicly stating that its goal is to hold 30% of its total reserves in gold to ensure national security. This is all thanks to the direction of its central bank governor. Poland is also moving its newly bought gold and older holdings directly from London to high-security vaults in Warsaw, which is very important. Hungary did the same thing, taking all of its gold reserves from the Bank of England and increasing its holdings by 10 times. Slovakia and Romania have also passed laws that require storage in their own countries. They all talk about betrayals from the past and how important it is to protect themselves from the weaponization of the financial system. What we're seeing is the opposite of the financial globalization that has been going on for the last 50 years. The central banks of the world are looking at a world where the U.S. national debt is growing quickly, now over $36 trillion. And financial sanctions are being used more and more. They understand the basic math fact that fiat currencies will eventually lose their value and pay off their debts. They're getting ready for a major sovereign debt crisis, a drop in the value of the dollar, or the breakdown of the global trading system into separate, hostile groups. In that terrible situation, entries in a Federal Reserve ledger that are digital are useless. You can default on a treasury bond. You can stop a SWIFT transaction. A physical bar of gold in a vault that your own military guards is the only asset that has no counterparty, risk, and does depend on the promise of a politician or the solvency of a foreign bank. The central banks know that the rules of the game have changed in a big way. They aren't playing to make money anymore. They're playing to stay alive. They're doing the biggest run on the US dollar system ever, and they're using heavy-lift cargo planes to do it. Moving hundreds of tons of gold around the world is a huge, high-risk job that goes against normal shipping rules. You can't just hire a logistics company and put the cargo on a commercial ship. When a country decides to bring back its national treasure, it starts a complicated, top-secret operation that includes chartered military-grade cargo planes, complicated permissions for international airspace, decoy flights to confuse possible enemies, elite mercenary security teams, and insurance costs that can reach tens of millions of dollars. The metal must be carefully checked, weighed to the ounce, packed securely in special containers that can't be opened, and moved by heavily armed, government-approved convoys from the underground vaults of Manhattan or London to a safe runway. At every stage of the journey, there is a real risk of spying, geopolitical interference, or terrible loss. The fact that the world's central banks are willingly putting themselves through this logistical nightmare and huge cost says a lot about how they are feeling right now. It shows that finance ministers around the world are now thinking in a cold, calculated way. The huge cost of moving the gold and building new megavaults at home is now seen as much less than the risk of leaving it with the United States or the United Kingdom. To really understand the panic that is causing people to leave, you need to look deeper than the surface level of geopolitics and into the murky, highly leveraged workings of the Western bullion markets. In particular, you should look at organizations like the London Bullion Market Association and the New York Commodities Exchange. For decades, the real exchange of gold bars hasn't set the global spot price of gold. Instead, it has been set by the frantic trading of paper contracts, derivatives, futures, and unallocated accounts. This huge financial machine works on a fractional reserve basis, just like a regular bank, but instead of paper money, it uses precious metals. There are dozens, and sometimes hundreds, of paper claims on the same physical ounce of gold that is sitting quietly in a vault in London or New York. These claims are traded digitally all over the world. This hyper-financialization of gold works well as a pricing system as long as most market participants are fine with settling their trades in cash, fiat currency, instead of ever asking for the physical delivery of the metal they say they bought. But the time of trusting the paper fantasy is coming to an end. Central banks, sovereign wealth funds, and very wealthy people are no longer happy with cash settlements. They want the real underlying asset. This change in behavior makes the Western bullion banking system feel a deep but quiet fear. When a country suddenly asks for the return of 100 tons of gold, they are effectively causing a bank run on the physical inventory that backs up the huge upside-down pyramid of paper derivatives. Central bankers in emerging markets are starting to worry that the Western custodial vaults may be too heavily leveraged. This fear is only made worse by the history of recent repatriations. The Federal Reserve said it would take 7 years to send Germany back some of its gold when the country famously asked for it back from the New York Federal Reserve over 10 years ago. When the German gold finally got to Frankfurt, independent auditors found that many of the bars had been made recently and did unmatch the serial numbers on the bars that had been deposited during the Cold War. The U.S. didn't just keep the gold. It seems that it had melted it down, rented it out, or used it in complicated swap deals. To meet the demand for repatriation, it had to get new physical gold. This event shook the sovereign wealth community to its core. The practice of leasing gold makes this fear even worse. In the past, central banks would lend their gold that was stored at the Bank of England or the Fed to bullion banks in exchange for a small amount of interest. Then the bullion banks would aggressively sell that physical gold on the open market to keep prices down, or use it as perfect collateral for other highly leveraged deals. Replacing the physical bar in the central bank's account with a paper IOU, the gold is still listed as an asset on the central bank's balance sheet, but the bar itself is no longer there. It has probably been melted down and sent to a market in Asia or the Middle East where people are hungry for it. In the event of a geopolitical disaster, if the central bank suddenly wants its leased gold back, the bullion bank must rush to the open market to buy physical gold at any cost to return it. A catastrophic short squeeze happens when many countries want their gold at the same time. Countries are playing a high-stakes game of musical chairs with their gold right now. They need to make sure they have a physical chair before the music of Western liquidity stops. Also, moving these reserves to a new location is absolutely necessary for the creation of a new parallel global financial system. The BRICS countries and their growing network of economies are working on new ways to make payments across borders that don't use the SWIFT network, which they see as a weaponized tool that Washington and Brussels control completely. Projects focused on multiple central bank digital currencies and different bilateral trade agreements are trying to fix trade imbalances in local currencies instead of relying on the US dollar. But fiat currencies from developing countries are naturally unstable, can easily suffer from high inflation, and don't have the deep, highly liquid bond markets that are necessary for them to work as a stable, long-term store of value. China, a major exporter, has a huge trade surplus with Russia, a major commodity producer. China doesn't want to keep hundreds of billions of Russian rubles on its books forever, and Russia doesn't want to keep an endless supply of Chinese yuan that is losing value. They really need a neutral, universally accepted settlement asset to clear the final balance of trade in order to create a strong, non-dollar trading ecosystem. Physical gold is an asset that has been used by people for more than 5,000 years and is accepted by everyone. But for gold to work as the ultimate judge and basic collateral for a new non-Western trading bloc, it needs to be physically present in that bloc's sovereign territory and legal control. If the physical collateral that supports the whole BRICS-aligned gold settlement system is in a wire mesh cage in lower Manhattan, it can't work. It could be taken away by a U.S. federal judge or a presidential executive order at any time. The gold needs to be sent back to very secure vaults in Moscow, Beijing, Mumbai, Warsaw, and Johannesburg so that it can be independently verified, possibly tokenized on sovereign, state-controlled blockchains, and used to start a whole new era of trade that doesn't use dollars and is backed by resources. This change in the structure of global wealth is killing American financial dominance. The United States has been a superpower because the rest of the world has always been willing to accept its treasury bonds as the safest, most reliable global reserve asset. For 50 years, when other countries sold a lot of goods to American consumers, they always put that money back into U.S. government debt. This kept U.S. interest rates low and made it easy to pay for the U.S. military's never-ending growth and the huge domestic entitlement programs. The Great Repatriation marks the final mathematical end of that very profitable deal. When a foreign central bank uses its trade surplus to buy a lot of physical gold and then coordinates huge logistical operations to fly it home, that's billions of dollars in sovereign capital that is not being used to buy U.S. treasuries. It's a quiet, slow-moving boycott of American debt issuance that is having a huge effect. As traditional foreign buyers quietly pull out of treasury auctions to stockpile physical metal instead, the Federal Reserve will eventually have to step in and become the buyer of last resort to keep interest rates from going out of control. This will almost certainly lead to a terrible wave of domestic inflation. It's not just a trade of heavy metal when gold leaves the fortified vaults of New York and London. It's the physical proof that global trust is permanently leaving the United States. And once that trust gets on a cargo plane and crosses national airspace, it almost never comes back. Taking gold out of Western vaults isn't the end of this financial rebellion. It's just getting ready for the last, most important attack on the U.S. dollar's global monopoly. Before we get into the details of how this new financial system will work and what it means for your money, please hit the subscribe button, like this video, and share it with someone who needs to hear the truth. Also, please leave a comment and tell me what country you're in and what time it is there right now. The only way we can get this important information to the public is through your involvement. To figure out how this gold rush will end, we need to look at the math behind the BRICS nations: Brazil, Russia, India, China, and South Africa, as well as their new partner states. They're not just buying a little bit of gold to protect themselves from inflation, they're taking over the market. Recent data shows that the central banks of the BRICS alliance and their close strategic partners bought more than half of all the gold that was mined around the world between 2020 and 2024. At the same time, these same countries now make up about half of the world's gold production. They are holding on to the current supply while also controlling the mining of the future supply. Controlling both the vaults and the mines is a quiet way of saying that you are economically independent. It's the creation of a financial bloc that is very strong and can't be punished. When you put together China, which is the world's manufacturing floor, Russia, which is the world's energy and commodity powerhouse, and India, which is the fastest growing major economy, and you back their trade with thousands of tons of gold, the US dollar is no longer needed. We can see this change happening right now. Over the past 10 years, the amount of intra-BRICS trade that is settled in local currencies has steadily increased. Now, about 1/3 of this trade does not use the dollar at all. They are trading oil for yuan and guns for rupees. This leads us to the scary effect on American citizens, the end of the unfair privilege. For 80 years, the United States has been an economic superpower, which has let it live far beyond its means. Foreign central banks had to keep huge amounts of U.S. currency because the rest of the world had to use dollars to buy oil and other goods. They put those dollars back into U.S. Treasury bonds. Because of this, a worker in Beijing or a miner in Moscow was basically paying for the American way of life. The fact that so many foreign investors were willing to buy our debt kept American interest rates artificially low. This let the U.S. government run multi-trillion-dollar deficits without causing immediate hyperinflation. And it also let American consumers buy homes and cars with very low-cost mortgage and auto loans. But what happens when that guaranteed foreign demand goes away? What if countries with trade surpluses bought physical gold instead of U.S. Treasury bonds and then flew it back to Mumbai or Warsaw? The math is hard and can't be avoided. The U.S. government currently has more than $36 trillion in national debt, and it adds another $1 trillion every few months. The Federal Reserve is the only organization on earth that can buy this debt now that foreign central banks are no longer coming to the Treasury auctions to do so. The Fed will have to be the last buyer to buy the Treasury bonds that the rest of the world doesn't want. They'll have to print trillions of new digital dollars that aren't backed by anything. This is how a change in the world can turn into a domestic inflation firestorm. When the Federal Reserve monetizes that much debt, the dollar's buying power goes down. The electronics, clothes, pharmaceutical ingredients, and car parts that fill the shelves of every major American store will all get much more expensive. As time goes on, the countries that export goods will want more and more worthless dollars for their goods. If they don't get them, they will refuse to accept dollars and will instead want payment in gold or other neutral currencies backed by commodities. The average American who makes a steady wage in a dying fiat currency will see their standard of living drop sharply. The time of cheap, endless consumption paid for by the printing press is coming to an end. This systemic shift necessitates a profound transformation in the methods by which individual investors safeguard their assets. You have to act exactly like the central banks of the world. The institutions that print fiat money are trading their paper for real metal at a fast pace. These are the smartest and most knowledgeable financial institutions on the planet. They're doing it quietly, over and over again, and they want it delivered in person. Why would you trust a commercial bank to keep your money if the Central Bank of Germany doesn't trust the Federal Reserve to keep its gold? Why would you trust a gold ETF in your brokerage account if the Central Bank of India doesn't trust a paper derivative contract in London? The lifeboat strategy for this new time is completely based on having things in your hands. Wealth preservation needs to go beyond the usual banking system. This means getting real gold and silver and keeping it yourself. You don't want to be exposed to paper gold, like unallocated accounts, futures contracts, or exchange funds that settle in cash in a crisis. When the system breaks down, there will be 100 times as many paper claims on gold as there are physical ounces. The fine print in those contracts says that you will be paid in fiat currency that is losing value, not the physical metal you thought you owned. Silver, in particular, becomes the best way for regular people to protect their money. Central banks and sovereign wealth funds use gold to pay off trade deficits worth billions of dollars. Silver, on the other hand, is the money of the people. It's easy to divide, everyone knows about it, and it has been used for everyday business during times of severe currency collapse. If you buy recognizable sovereign-minted silver coins or junk silver coins made before 1965, you will have something to trade when the digital payment networks stop working or the local currency stops being a way to pay for things. We're seeing the end of the unipolar fiat system. The huge movement of gold from the west to the east and from offshore vaults back to sovereign soil is the loudest alarm bell the global financial system can ring. It shows that people no longer believe what indebted Western governments say they will do. The rules of wealth are going back to what they used to be. Gold has been the most important measure of value for 5,000 years. It is the only money that has survived the fall of empires and the arrogance of central planners. The countries of the world are building their financial arcs by trading their paper dreams for the cold, hard reality of precious metals. The storm is no longer on the way. It's here. The only thing left to ask is whether you'll have a paper promise or a real asset when the water rises.